Well, we've taken the outlook from negative to stable. And the main driver behind that was that the industry is in a much better position from a risk-adjusted capital standpoint and from a liquidity standpoint, we think, to absorb any risks that the industry is also facing. The last couple of years, there's been a lot of challenges, whether it's been the uncertainty with the presidential election, whether it was whether taxes were going to be changed. We think a lot of that's been cleared up. What's still out there is some investment risks, so we really think it's important that the capital is there to reflect any potential problems there. Profitability has also done very well for the industry. Now, more recently, we have some tailwinds from the interest rates starting to tick up a little bit and the tax laws, so we think going into next year, profitability should be able to hold up pretty well. The overall business profile is improving. There's been a fair amount of M&A driven from the reinsurance side, and we think blocks of business are ending up with those that are better equipped to manage them. So without losing diversity, companies have been able to focus on specific lines of business, which keeps management attention in the right place. And then finally, ERM improvements. That's something that always has to change, always has to be evolving, but we think insurance companies have done a good job, a lot of way to go there, but they're in a good position and starting to make real important decisions based on their ERM capabilities. I think in the near term, I'll go back to the why the risk-based capital, risk-adjusted capital is so important, because we think there's there has been increased investment risk the last couple of years, whether it's on the credit side or whether through illiquid investments. So it's going to be really important as we potentially see that benign credit environment, sort of the frothy equity market start to turn in the other direction. We're already seeing the increased volatility on the equity side, but we're pretty certain that somewhere along the second half of 19 or 2020, we'll start to see more credit hits start to hit the portfolios. Maybe not in wholesale impairments, but we'll start to see some rating migration where capital become very important. There's also probably some stress on the profitability, basically from regulatory increases and costs around that, and from the cost of innovation, that's sort of an ongoing cost that's been added to the insurers.